note to it, no adjustment. So 52,000 was it. That was what the value was. So we'll put it here, 52,000. License 34,600. 34,600. Then long-term notes, we had adjustment. Long-term note receivable, there's an adjustment to it. It is 61 according to the financials prepared, 61,300. There is a note 6 on the debit. So please, these are item of debit, please. 52,000, 34,600, and here is 61,300. They are debit items, please. There is a note. There is a note attached to this, and we'll check that in note 6. In note 6. In note 6. What is note 6 all about? Note 6. At the year ended 2010, St. Mike Limited had notes receivable totaling 61,300. St. Mike Limited recognized impairment of these receivables in 2010 amounted to 15,700. The company has determined that the same write-down would have been needed in IFRS financial statement for 2010 at the year ended 2011. St. Mike Limited continues to hold these notes, and debtors credit rating has improved dramatically. As a result, the present value of the expected future cash flow from the notes has increased to their full face value of 77,000. Full face value of 77,000. So we are going to carry it based on the fair valuation value. So that is item number 6. And item number 6 is governed by what? By IAS number 39. So IAS number 39 permits companies to recognize a recoverable of a previously recognized impairment losses or receivables. So St. Mike must present a loss recovery of what? Of the difference. We are going to prepare a loss recovery of this difference. So we are going to recognize as 77, and the loss recovery difference is what? Is 15,700 in other revenue and gains section of the income statement. So in addition, the carrying amount of the long-term note receivable in the statement of financial position must be increased to the full face value of 77,000. So this is how we are going to reflect it. We are going to have 77,000 as the full face value of it. Then the difference of 15,700 will have to be recognized in the income statement. When we get there, we'll do that. Okay. Account payable. There is no adjustment to it, to account payable. So we are going to pick the value as it were in the financials reported. As it were in the financial reported. So 87,100. So we shall report it as 87,100. No notes that requires adjustment to it. Then we have accrued expense also, no notes that require adjustment to it. 34,400. So 400. Okay. So customers what? We also have a customers deposit. There was no additional note item that requires adjustment to it. So we report it as it were. We report it as it were, which is 26,900. We shall report is the same. Okay. Then we now have bank overdraft. We shall recognize bank overdraft. We'll net it. And what we mean by netting? So overdraft of 85. Remember that 8,500. And we are saying we have to net it. Note 5 took care of that. is the net, so that we are going to have 0 in the case of the what, in the case of a liability. So bond payable, according to the statement, we had it as 120,000 and no adjustment, so we shall report it as well as 120,000 in the IFRS balances. The long-term notes payable, in the financials given is 113 200. No adjustments done to it. 113 200. No notes that's requiring us to do adjustment to it. Long-term lease obligation. Long-term lease obligation. We have it there in the financial prepare as 91,600. Okay, so we'll report it as well as a 91. No adjustment to it. 600 as the IFRS balances. We had deferred income tax liability non-current. And that will form our 8B. Remember, I told you that that we have to net if it is if it is the same from the same taxing authority. It have to be netted. It have to be netted. So let's see 8. Note 8 takes care of what? 8B takes care of that. In the financials, it was reported as 54,700. So we have to use note 8B to adjust for it. Okay. So go back to note 8B. Note 8 rather, please. We'll go back to note 8. St. Mike Limited defer income taxes under US GAAP at year ended 2011 were as follows. Okay, this is it. Okay. Non-current defer income taxes. Non-current defer income taxes was this. Defer tax asset, please. And non-current defer income tax liability was this. Okay. And we also told that all of the above defer income taxes amount were levied by the same taxing authority. And I have to recall what we have said earlier on, that under similar to what the US GAAP, IFRS require companies to consider the need for a write down of tax liability. Let's see. So that's not note 8. This is note 9. Note 9. Okay, let's look at note 8 first. Note 8. Note 8 is on inventory. Note 9. Rather, it should be note 9. Note 9 is what we read earlier on. So you can see we have dealt with this earlier on. I would like us to pay serious attention here regarding to this deferred income tax liability, which is a non-current asset. Look at how we're going to go about it. Let's go to the statement. The first we are going to pick here is 8B. So where is the 8B in our adjustment? The 8B in our adjustment is this 168, and that indicates what? Indicates an increase. So this will become a what? This will become what? We'll debit it. We'll debit it, as you can see. So what is the tax on it? Remember, the tax rate is 35%. So I need to show the workings somewhere. Okay, let's put it workings here. So 8B, we're having 16,800 times 35% to get the tax element on it, and that will give us 5880. So this is an assets. So we'll put it there. Where is it? 8B, asset 5880. Okay, haven't done that, we move to all the adjustment that requires increase or decrease. So we'll take 1A. 1A. We'll take the 1A, and that is under land. You can see 1A. We'll take 1A, 1B. All this 1A, 1B becomes is an increment in what? The value of the asset. An increment. So it becomes a liability. 1A, 1B. Let's go. So 1A, increment in asset by 23,000, 35% of it will give us 8050 liability. So on the credit, 1B, also increment in valuation 15,000, 35% of it is the liability element 5250. Okay, so we can insert it now. Can put it here. A1, we have it as 8050. A2, or sorry, 1A, 1B. 1A, 1B. So this is 1A, additional information 1A, additional information 1B that we adjust, and the tax element there is 5250. Okay, so we go for 3A. 3A. And that 3A is inventory. Let's pick it from here. Inventories 3A. Can see that as an increase in inventory. So we'll find the tax element of it on it. So that is a 3A. 3A, increase in, that is 25,800 times 35% of it. It will give us the tax element of 9030 is a liability. So 3B is also increase 58,700 times 35%. 58,700. 58,700 times 35%. This is 35%. It will give us 20,545, a liability because it's an increase. Then number 6. Number 6 is on long-term note receivable. Long-term note receivable, we have it as 15,700. If I put this value, let me put this value in 9,013 naira. So we have note 6, which is long-term liability 15. There's an increment of 15,700. So we have it as 6 15,700 times 35%, and that will give us a total 5495 CR. It will be a liability because the changes was affected. And see on the debit, so it become a liability. 6, we have it as 5495. So 8A, note 8A will now come in. Let's locate 8A. 8A under the 8, and note 8, we use note 8. Yes, you can see 7,100. So it becomes a liability. (8A) 7,100 times 35% of 8 should give us 2485. So we'll put it 2485. Okay. Then we had note 9. We had note 9. Note 9 is taken care of with deferred income tax current. Deferred income tax current. Let's see. Deferred income tax current. As you can see. Look at it. Note 9. Alright. This is non-current. Okay. 9. Deferred current tax. Current. As you can see. So we'll bring it in. It's wholly. We'll pick it. Wholly. So 21,600. So note 9, 21,600. So this is a liability. So this is an asset. DR is a liability. So we need to sum up. So let's sum up. At least we want to sum everything. Debit will be minus, credit will be addition. So we'll do that. Let's see. 5880. That is a minus 5880 plus 8050 plus 5250 plus 9030 plus 20545 plus 2485 minus 21600 equals to 17880. And from previous gap we had 54700. I hope I'm very, very correct. Let me see. Let's add back again. Minus. Okay, let me add the credit side together. Let's add the credit side together. 8050 plus 5250 plus 9030 plus 20. Wow, there's an item I've not put in. 3B. I've not put in 3B. I've not inputted 3B. 3B, as you can see, 2545. 2545. Okay. 2545 plus 5495. Okay. So plus 2485. We have it as a 5855. So now minus 5880 minus 21600. We have it as 23. So this is wrong. We have it as 23,375. We'll now add plus 54,700. It will now give us a total of 78079. 78075. 075. So our deferred income tax liability is now 78075. Okay, so that is it. This take more longer time because we have to be very, very careful here. Okay. Wow.